And there you have it, the closing bell from the New York Stock Exchange. It has been another roller coaster ride on Wall Street. The Dow had a strong start, but gave back some gains throughout the day. But it ultimately closed up just around 1 point or so.
The Nasdaq and S&P 500 also had wild swings, closing slightly down. Meanwhile, GDP report out today was better than expected.
It shows 6.9% growth versus the 5.5 prediction. This is despite the Omicron surge and rising rate of inflation. To discuss all of this, let's bring in Ann Sonders. She's a chief investment strategist at Charles Schwab. Hi, Ann. Great to have you with us.
Hi, ladies.
Nice to be here. Great to have you. What else stood out to you in this GDP report, and what does it mean for the markets?
So what stood out was what a large percentage of what was a better than expected number was inventories. When the problem there is that when you build inventories that much, that it's a huge contributor to growth in an environment now that we're in the first quarter where demand is slowing and consumption is slowing, that actually sets up the decent likelihood that we have a bit of a boomerang, meaning weaker than expected growth in the first quarter, given that inventories have been pumped up because of all the pandemic-related issues. So we may actually start to face some, believe it or not, supply gluts in parts of the economy. So that's the swing that could happen into the first quarter.
Ann, do you expect inflation and consumer demand to slow down anytime soon? And how could that affect our family budgets?
So eventually, yes. In fact, one of the forces that will come into play, maybe starting around the middle point of this year, is the opposite of what happened about a year ago. So most inflation measures like consumer price index are measured in year-over-year terms. And a year ago, when we first got that inflation spike, the eye-popping increases were largely a function of the comparison to the year prior when we were in lockdown mode and prices of many goods and services went actually into deflation mode, started to decline. So that's called the base effects, where you get that year-over-year significant jump. Well, the opposite is set to happen as we get toward the middle part of the year. So simple math suggests that we're going to see an easing in some of this pressure, plus some of the leading indicators, things like supplier delivery times, what manufacturers are paying, prices paid as an index. And those are starting to not sink to a significant degree, but they've rolled over and they're seeing less of an appreciation pace. So we're starting to see, call it those green shoots of better news down the road. But unfortunately, it's not imminent. And things like the semiconductor shortage, that is a long time horizon before that is seen as something in the rearview mirror.
Well, all of these green shoots that you just mentioned, these little, bits of hope out on the horizon there for the economy, does it have anything to do with, as we know yesterday, the Federal Reserve signaled that it will start boosting interest rates in March? Is that tied in any way? And what do you think the hike will mean for Wall Street and Main Street?
Yeah, so I think, the Fed's moves, which they haven't actually done much yet, they haven't started raising interest rates yet. They have lessened the amount that they're adding to their balance sheet, but they're still in easing mode. But simply their words are sending a message that tighter policy, tighter financial conditions is coming, and that can sometimes change the psyche. And I think to some degree that is happening. Plus, inflation in and of itself is actually causing some weakness in demand, causing some weakness in growth. I don't remember who said it originally many decades ago, but the best cure for high prices is high prices. So inflation itself is having the effect of putting some downward pressure on demand, where people are just saying, you know what, I can't afford it, or this makes no sense. And that's not universally across all goods and services, but it's starting to creep in a bit more. So we actually have inflation, the force that the Fed is trying to combat, starting to do a little bit of the job for the Fed in maybe easing demand in the interest of allowing supply to continue to catch up to demand.
Valuable financial insight. Ann Sonders, thank you.
My pleasure. Thank you.